This is Nightly Business Report with Sue Herrera and Bill Griffin.
Rocky market. Stocks post steep weekly losses as concerns rise about the global economy, and investors try to figure out what to expect in the weeks and months ahead.
Powerful rally. Shares of the utility at the center of a California wildfire soar after a regulator eases bankruptcy fears.
Frequent flooding, the rising risk facing one of the sites Amazon picked for its second headquarters. Those stories and much more tonight on Nightly Business Report for this Friday, November the 16th.
And good evening, everyone. Well, sometimes we're glad it's Friday, especially after a volatile week like this one, which left investors scratching their heads. Today, some optimism over trade sent the Dow and the S&P higher, but tech and the NASDAQ dragged like they did pretty much all week. Here are the closing numbers for you. The Dow gained 123 points to 25,413. The NASDAQ fell 11, and the S&P 500 added 6. For the week, all of the major averages were lower. And it wasn't just stocks. Oil prices suffered their sixth weekly loss in a row.
Some analysts believe that the decline in oil prices does reflect a slowing global economy. And in fact, the Federal Reserve's number 2 official said today he is turning cautious on worldwide growth.
Although our mandate is full employment and price stability in the U.S., to achieve that, we have to understand and factor in the global economy. And there is some evidence of global slowing. I think it's early days. That's something that is going to be relevant as I think about the outlook for the U.S. economy.
And despite his concern, Clarito does not think that the Fed is raising interest rates too quickly.
Those sentiments were echoed today by the head of the European Central Bank, who said the Eurozone economy has slowed in recent months and the outlook is now cloudy.
We've recently seen a loss of growth momentum. In both of the last 2 quarterly ECB growth projections, our staff has revised down its estimates. Actual data have also been weak. The flash estimate for euro area growth in the first quarter was just 0.2%. The slowdown has raised questions about the strength of the growth outlook.
Draghi also said the ECB's plans to start raising interest rates late next year could change if inflation slows.
So a slowing global economy is just one emerging concern right now. The tech sector is under pressure. There are trade issues. And then there's the Fed. Joining us for a strategy session tonight, Kevin Curran, the portfolio manager at Washington Crossing Advisors. Good to see you again, Kevin. Thanks for joining us.
Good to be here.
We've all been wondering why the sudden volatility in the market started in October and continues into November. Is this a market anticipating a slowdown? Is that what's going on here, do you think?
I think it is. I think it's a market that's anticipating a global slowdown, as you've just been discussing, right, and also pointing to the fact that the United States can't escape the gravitational pull of the rest of the world. So if you look at China, basically the hub of a lot of production on the planet, China's been slowing materially. Their industrial side has slowed down recently. We see their market in a bear market territory. And overall, industrial metal prices have fallen dramatically. So the United States is now stuck being confronted with a worsening global environment in which to participate. Which
means that if investors want to participate, you've given us some highlights of what they really need to keep in mind. And one of the things is the balance sheet and how much debt a company that you may be investing in is carrying.
Yeah, so if, for example, we had a continuation of deterioration in the outlook, you would want to look through your portfolio and do a few things. Number one, look at the companies that you own in terms of the stocks. Look at the debt on their balance sheets. Many companies have taken on debt in the last few years to do acquisitions, et cetera. And just be careful that companies haven't gotten over their skis in terms of having too much debt.
As far as dividend payments, though, a lot of people want dividends. They're looking for that for income, but we're in a rising interest rate environment. We've talked in the past about how that's a dangerous strategy, but yet where do you go to get that income then?
Yeah, you're right. A lot of investors have looked for dividend income off their portfolio. And one thing you can do if you're concerned about a potential slowing from here over the horizon is look at the earnings that a company generates. And let's say a company generates $1 worth of dividend. Maybe you want to see that company generate $2 of earnings so that if earnings were to fall, that dividend would have less of a chance of being cut.
So look for quality and look for higher earnings relative to their dividend. Kevin Carone with Washington Crossing Advisors. Always good to see you. Thanks. Have a good weekend.
Thank you.
And now to a story that we've been following all along, the California wildfires and the utility at the center of that investigation. Shares of PG&E rebounded sharply today after losing more than 60% of its value in a week. The surge comes after a regulator eased bankruptcy concerns and also hinted at state support for the embattled company. Aditi Roy has more from San Francisco.
As the death toll from Northern California's Camp Fire climbs, the president of California's Public Utilities Commission speaks out about the utility at the center of the investigation. In an unusual move, the regulator held a conference call with a group of analysts, which was hosted by Bank of America, according to a source familiar with the matter. During that call, he told them the commission did not want to see PG&E go bankrupt if it's held liable for the fire. That prompted shares to soar today after 6 straight days of losses, despite both Moody's and S&P downgrading the utility's credit rating last night. Some insiders say a PG&E bankruptcy would hurt customers, who could eventually end up shouldering the costs.
For every dollar that Pacific Gas and Electric incurs in terms of these damaging wildfires, that is ultimately going to have to be paid by ratepayers in one form or another.
But others say even if PG&E doesn't go bankrupt, the rate customers pay could go up to help cover PG&E's liability costs under a California state law. And some consumer advocates say that's not fair.
Customers don't share PG&E's profits when PG&E is profitable, but it seems that we're going to be expected again and again to share its liabilities when it's negligent.
The law only applies to the 2017 California wildfires, and lawmakers would have to decide whether to extend it to this year's fires as well. PG&E has been found responsible for more than a dozen fires last year, which analysts say could cost $13 billion. Meantime, the commission's president plans to launch a wide-ranging review of PG&E, examining the corporate governance, structure, and operation of PG&E, including in light of the recent wildfires, to determine the best path forward.
PG&E gave us a statement addressing the bankruptcy issue, saying that the utility agrees with the president's statement that an essential component of providing safe electrical service is long-term financial stability. For Nightly Business Report, I'm Aditi Roy, San Francisco.
Elsewhere, Facebook's latest controversy has gotten the attention of lawmakers. As we reported yesterday, an expose by the New York Times pointed to mismanagement at the company, including efforts by top executives to conceal gross mismanagement and negligence. Facebook continues to deny those accusations. But as Julia Borston reports, Washington, Wall Street, and advertisers are watching very carefully.
Facebook COO Sheryl Sandberg denying the New York Times reports of mismanagement at the company, writing on her Facebook page, quote, to suggest that we weren't interested in knowing the truth or we wanted to hide what we knew or that we tried to prevent investigations is simply untrue. But Senator Mark Warner says he's disappointed with Facebook's management.
What they've said is, yeah, we want to work with you, but when we get to specifics, there's not been a lot of give on their side. But the notion that the wild, wild west days of no regulations at all, no guardrails, just can no longer exist.
Senator Warner isn't the only one calling for regulation. Fellow Democratic Senators Klobuchar, Blumenthal, Coons, and Hirono wrote to the Department of Justice, urging an expanded investigation into Facebook and Cambridge Analytica, saying, quote, disturbing recent reports allege that Facebook took significant steps to undermine efforts to hold them responsible, including hiring partisan political consultants to spread disinformation about people who have criticized Facebook.
Definers, the D.C.-based communications firm to which the senators are referring, responding that, quote, it was not hired by Facebook as an opposition research firm, saying that its main services for Facebook were media monitoring and PR around public policy issues.
AOL founder and tech investor Steve Case says now the pressure is on for Facebook to make changes.
They have to understand that they do shoulder a great responsibility. Hopefully they will make the moves necessary. I think they have the right intent. They've been clear about the intent. I think a lot of people are looking for the actions now to follow the intent, and hopefully in the coming weeks and months we'll see more of that.
And investors and analysts are watching to see what impact this controversy has on Facebook's bottom line.
I think they are taking much more serious steps than a year or two ago. From a business perspective, I think we're seeing signs of users, certainly in 3Q, a little better stabilization in the user base than we saw in the second quarter.
One ad agency, Horizon Media, says they're watching to see if consumers start to retreat from the platform because of the negative headlines. For Nightly Business Report, I'm Julia Borston in Los Angeles.
And Facebook shares fell in trading today. They were down 3% to a multi-month low. The stock is now down 35% from its most recent peak in July. And even if you don't own the shares outright, you might own them in an ETF or a mutual fund. The top holders include the Vanguard Total Stock Market Index, the Fidelity Contra Fund, and the Vanguard 500 Index Signal.
Time to take a look at some of today's upgrades and downgrades. And we begin with Home Depot, which was downgraded to neutral from buy at Bank of America Merrill Lynch. The analyst there says that earnings will peak this year and sales probably peaked last year. Price target $195. The shares fell fractionally today to $177.02. Michael Kors was downgraded to perform from outperform at Oppenheimer, with the analyst citing ongoing inventory management issues. Firm also said that the integration of the recently purchased Versace could prove costly. Shares fell more than 2% today to $45.89.
Morgan Stanley removes its sell rating from Qualcomm, upgrading that stock to equal weight from underweight. The analyst says the company's risk-reward profile is more balanced now, and the price target is $55. The shares initially rose fractionally to $55.88. Target was given an overweight rating at KeyBank in new coverage. The analyst there cites the retailer's investments and improved execution. The price target is $110. The shares fell 1% to $79.68.
Still ahead, the rising risks facing one of the sites of Amazon's new second headquarters.
Airbnb's revenue breaks through the $1 billion mark. That makes the third quarter Airbnb's best quarter yet. The company cites growth in overseas markets as well as in smaller towns and suburban areas. The results come ahead of a highly anticipated IPO next year.
We told you earlier this week that Amazon had selected Long Island City as one of the two locations for its second headquarters. Well, it turns out that site could be at risk of major flooding as a result of rising sea levels and increasingly extreme weather conditions. Diana Olick has the latest installment of her series, Rising Risks.
Long Island City may seem ideal for Amazon. Stunning views of Manhattan, easy access to transportation, and shiny new residential towers already rising by the water. But there is also a rising risk of water. Flooding at the proposed 4 to 8 million square foot Amazon office development. It is located in a floodplain.
Building on the lowest spot in Queens is not long-term thinking. This is clearly building square in the danger zone for frequent flooding.
New research from Climate Central and Zillow shows the area could see significant coastal flooding by 2020. Extreme projections of sea level rise have low-lying buildings underwater by 2050. Amazon could build seawalls and take other steps to make its headquarters resilient, like developers at nearby Brooklyn Navy Yard's new Dock 72, which is just south of Long Island City, also on the river and literally hanging over the water. It is a collaboration by Boston Properties and Rudin Management.
Our lobby is 8 feet above the water line. All of our mechanicals are on the second and third floor. And so, we are very focused on resiliency.
And the same is true at the massive Hudson Yards development on Manhattan's west side. also built right by a river but over train yards, so it's elevated. Amazon could raise the ground under its new offices and raise all the building systems.
But then you have to ask, how easy will it be to get to and from their headquarters? What's happening to the surrounding neighborhood? And they're going to need the city's help to fortify the whole area.
From 2005 to 2014, Queens saw an additional 31 days of coastal flooding due, researchers say, to climate change. If Queens saw a 6-foot flood, which scientists expect by the end of this century, that would put $13 billion worth of property at risk of damage, about 34,000 homes. It is highly likely Amazon is already factoring in the added costs of water and storm resilience. We asked an Amazon spokesman about any plans, but he said he could not comment. For Nightly Business Report, I'm Diana Olick in Long Island City.
And to read more about the growing flood risk to Long Island City, you can head to our website at NBR.com.
Mission Impossible powers Viacom, and that's where we begin tonight's market focus. The media company's better-than-expected quarterly results were helped by box office revenue from the Tom Cruise sequel. Viacom also benefited from a rise in fees paid by cable and satellite companies and says it expects revenue to grow next year. Viacom shares rose more than 3% to $32.99. BlackBerry is pushing further into cybersecurity with its purchase of Cylance for about $1.5 billion in cash. The deal will expand its unit that makes software for next-generation autonomous cars. Cylance will operate as a separate business unit within BlackBerry. The shares rose 1% to $8.97. GE's finance arm is selling its healthcare equipment finance portfolio for $1.5 billion to TIAA Bank. This deal comes about 1 month after it sold a portfolio of energy investments to a private equity firm. GE shares finished down nearly 2% to $8.02.
AstraZeneca reported disappointing results from a drug trial. 2 of its experimental cancer medicines offered no advantage over chemotherapy in previously treated metastatic lung cancer patients. Shares fell more than 1% today, 1.5% really, to $40.67. Pfizer plans to raise prices on 41 drugs come January. That's about 10% of its lineup. Most drugs will see a 5% increase. The company had previously rolled back price increases this summer under pressure from President Trump. Shares rose marginally to $43.51 today. And cancer drug company Tesaro is reportedly exploring a sale. The report comes about a week after shares fell sharply on disappointing drug trial results. After being halted for a time in today's trade, Tesaro's shares popped by 31% to $34.96.
It's time now for our weekly market monitor, who has names of stocks he says are less vulnerable in an economic downturn. Joining us is Tim Courtney, Chief Investment Officer at Exensal Wealth Advisors. Welcome, Tim. Welcome back, actually. It's nice to see you again.
Yeah, thank you very much.
You have picked 3 kind of eclectic picks for us. The first one is Starbucks, and you like it partly because of its expansion possibilities in China.
Yeah, they're opening about a store a day in China. That's a big growth venue for them. And also in the United States, they're introducing new menu items and introducing greater use of drive-through, which has been shown to increase their sales in the U.S.
Another one we have here, I don't even know how to pronounce this. Zoetis, is it? You know, we hear from so many money managers who like companies involved with our pets, whether it's pet food or housing or whatever it is. This is a vaccine company in animal health, right?
Exactly, that's right. You know, with the so many more dollars being spent from households on pets, it's their earnings growth is low teens, and so very good. They also made an acquisition of a company that does diagnostics, primarily for livestock, but also for household pets. And so that just continues to be a growth area as more money is spent on those in those areas.
Well, we both have pets, both Bill and I, so we spend a lot of money on them, that's
Indeed.
for sure.
Yes.
And our third pick is Xylem. It's water infrastructure, partly. Why else do you like it?
Yeah, it's mostly that. I think a lot of people don't know exactly how much water is actually lost in municipal systems, and a lot of municipalities don't have the wherewithal to be able to find leaks where they're happening and diagnose them and fix them. And so this company helps to find those leaks, make sure that water delivery is more efficient, and their hardware, their pumps and meters that they're able to provide helps companies all across the world or municipalities all across the world function more efficiently. So as infrastructure spending increases, they should be reaping the benefits there.
And again, very quickly, the theme here for these three, these are companies that you feel can weather any economic slowdown, right?
That's right. Starbucks last go around did slow down as consumers slowed their spending during the last cycle. But in general, they're all growing low teens in terms of earnings. They're growing high single digits in terms of revenue. And we feel like all of these should fairly well weather a slowdown.
All right. On that note, Tim, thank you so much. Tim Courtney with Essential Wealth Advisors. And to read more about Tim's picks, you can head to our website, NBR.com. Coming up, an iconic toy story.
I'm Courtney Reagan in New York City at an iconic toy store that's back just in time for the holiday toy war. I've got the story coming up on Nightly Business Report.
Household debt is on the rise. A new report from the New York Fed says that total indebtedness increased for the 17th consecutive quarter to $13.5 trillion. That includes mortgages, auto loans, and credit cards. But economists say that it's not yet a cause for concern since debt levels are still far below where they were 10 years ago at their peak, and Americans are mostly able to keep up with their payments right now.
So with households in a better financial condition, economists say that could be a good sign for consumer spending. And the new FAO Schwarz store in New York hopes that that is indeed the case. Courtney Reagan has more on this legendary toy store return to the Big Apple.
Iconic toy store FAO Schwarz returns to New York City just in time for the holidays, but in a new location and with a new owner. The original New York City toy store closed in 2015. A year later, 360 Group bought FAO Schwarz from Toys R Us. Today, the new store in Rockefeller Center opened for the first time, just down the street from the old location.
Today, we're making history. This FAO Schwarz store will be better than ever before, and it will be here to stay.
A true toy experience is the key here at FAO Schwarz. Like at this baby adoption center, you can't leave until you've been interviewed by a nurse or a doctor to prove that you're a fit parent.
It's just something you grew up with, and I just wanted my kid to experience the same thing too.
It was nice to see the piano and some of the stuff that was in the older FAO Schwarz.
It's like really interactive. It's really different from all the other toy stores I've been to, where you just pick something out and leave.
Most FAO Schwarz toys are sold at other retailers like department stores, but the most popular toys' roots can be traced to the original New York store. It's the first holiday season without Toys R Us, and retailers of all kinds are trying to grab the market share the toy store left for grabs. Department stores like Kohl's and JCPenney are expanding their toy assortment, along with big box players like Walmart and Target, adding exclusive products and shelf space for the holiday season and beyond. Amazon put out its first toy catalog. Even grocery stores like Kroger are getting into the toy business. So which retailer will win the toy war? According to a survey of former Toys R Us shoppers, Amazon is the first choice for toys, followed closely by Walmart and Target. Even specialty stores like American Girl and Learning Express have been able to gain share. The battle plans are set and the troops are in place to win the toy war, with Black Friday now just a week away. For Nightly Business Report, I'm Courtney Reagan in New York City.
Well, while some buy toys, others buy art. And lately, those buyers have been bidding prices up to records. For the most part, they were out in force again this week, despite the recent rough patch for the stock market. Robert Frank reports for us tonight.
It is known as Golden Week in New York. More than $2 billion worth of fine art and collectibles auctioned off just this week. And despite the stock market jitters and slowing global growth, the world's wealthy keep on spending.
Where should we open this? 18 million, 19 million, who'll offer me 20?
Now, the star of the week was artist David Hockney, whose portrait of an artist sold at Christie's for about $90 million. That made it the most expensive work ever sold at auction by a living artist. Now, Edward Hopper's Chop Suey, depicting a Chinese restaurant in New York City that he used to visit with his wife, sold for $92 million, a new record for traditional American art. Now, women and African American artists are in huge demand right now as museums and collectors diversify their collections. This Joan Mitchell piece, called 12 Hawks at 3 o'clock, went at Christie's for $14 million. Jacob Lawrence's The Businessmen set off a bidding frenzy and sold for about $6 million, 3 times its estimate.
Thank you, Val.
Now, there were a few misses where sellers overpriced their works. This Marston Hartley, estimated to sell for over $30 million, failed to sell, as did a Van Gogh. Now, the fear was that the stock market declines would spook the hedge funders and Wall Streeters who buy art, and that China's problems would dampen Chinese buying. But Asian buyers were out in force, especially for jewels. Marie Antoinette's pearls went for $36 million, about 7 times the estimate. And one of the biggest pink diamonds ever sold went for $50 million.
The Chinese and Asian customers, Hong Kong in particular, of course, very important to the art market, very important to the diamond market, and they have been some of our biggest buyers and bidders for colored diamonds.
The stone was nearly 19 carats and was sold to Harry Winston, who plans to sell it to one of his own clients for even more. For a Nightly Business Report, I'm Robert Frank.
Before we go, one final look at the day on Wall Street. A mixed day. The S&P and the Dow were higher. The NASDAQ was down today.
And that will do it for us tonight. Thanks for joining us. I'm Sue Herrera.
I'm Bill Griffith. Have a great weekend. See you Monday.